Okay, so as I said, our lesson for this evening is based on accounting concepts and types of business organizations. So we are looking first at accounting concepts. All right, all right, good. So I've given you a definition as to what is accounting concepts. And the definition given is that accounting concepts are guidelines which help accountants to prepare financial statements for users, and these users, of course, are stakeholders in decision making. All right, so you need to bear that in mind. Accounting concepts are guidelines, okay, and basically it helps stakeholders to be able to get a clear indication as to what is going on with the business by applying these principles or these concepts. All right, so we're going to look at a few. I have just about 8, I believe, I have extracted, okay, which is 8 easy ones we are going to look at. There are other concepts, but I will not want to introduce them just yet. These are the ones that I feel that is easy for you to understand. So we're going to go straight into it. So we're going to look at the business entity concept, also known as the economic entity concept. Whichever one you've seen, it means the same. So this concept states that the transaction of an entity are to be treated as being quite separate from the personal activities of its owner or owners, okay? So when you think about the business entity concept, it's important for stakeholders because what happens is that sometimes owners will sometimes use monies from the business to look after their personal needs or their personal wants. That is not supposed to be that way. When you are applying the business entity concept, it's important for you to differentiate between the business and the owner. I have given you an example here. So you are the owner of a business and you decide to withdraw money from the business to pay for your child's textbooks. Such a withdrawal, should not be recorded in the books of the business because it is a personal transaction of the owner. So remember, if you have a business, you cannot use your personal transactions to record it in the books of the business. That is incorrect. It's not supposed to be done. And one of the reasons why you should not do that is because it allows like the government to have problems controlling how much profits, or not controlling, I shouldn't say the word controlling. Governments will have a problem in assessing the profit of a business. So if it is you are putting expenses into a business, then really and truly you will not be able to show the true profit. If you put your personal expenses into the business, it would be difficult for you to know your true profit of the business. So if it is, let's just say your business has to be taxed by the government, it would be difficult for them to do that because you have incorporated both business and personal expenses into the business. That is incorrect. It is not supposed to be done. And this principle outlines, this business entity concept outlines that that is one of the things that should be taken into consideration when recording information into your accounting books. Okay, hope that is clear. Good. Okay, I'm seeing some questions. So here's what I'm going to do, guys. I'm definitely going to, I just want to get these 2 lessons in this evening, and I'm going to try and finish, let's say about maybe early enough so that I can accommodate your questions. All right. So let's look at the other concept. I'm sorry, guys, but it's not like I don't want to answer your question. I just want to fit in these 2 lessons this evening so that next week we can move on, all right? So let's look at the other concept. The other concept, the historical cost concept, is also known as the cost principle concept. This concept or principle states that acquired assets and services should be recorded at their actual cost and not at their current market cost. So let's use an example here, and then I'll explain further. If a business purchased land for $20,000 10 years ago, and the land is now worth, let's just say $100,000, the historical cost that should be recorded in the books of the accounts is $20,000 and not the current market value of $100,000. Okay, so we need to recognize this concept in accounting. Now, a lot of people will say, why not record the cost of the whatever it may be? It could be an antique piece of furniture. One might ask, why not record the market value? We would not record it. Why? I would say it's because, let's just say you have to sell or you have to dispose of that fixed asset, which is the furniture. If you have to dispose of it, then you will not know whether you have made a profit or loss on that item. So it's important for you to record the cost of the item or the furniture or whatever it is you have purchased. It is important for you to record it at the price of inception, meaning when you have purchased it. All right, so we are going to, I hope that is clear. No, Jadon, do not write it down, honey. You can get it. You can get it after on YouTube, all right? It's too much for you to write. I would prefer if you just listen, honey. Okay, good. All right, so we are going to the third one, which is the money measurement concept. Let's look at it. Money measurement concept. This money measurement concept states that a business should only record an accounting transaction if it can be expressed in terms of money. If it cannot be expressed in terms of money, it should not be recorded in the books of accounts. So I have given you 2 examples here. For instance, the efficiency of management. If you have a management team in an organization that is performing very well, there isn't a price value or a monetary value you can put on their performance. So that should not be recorded in the books of accounts. If it is, you get really good customers supporting your business, again, you cannot put a price or a value on the support that you are getting from your customers. It is difficult for you to do that, okay? So you cannot or you will not record that kind of support in your books of accounts, or how well a product is working for you. That cannot be recorded in the books of accounts. So you would record only things that can be expressed in terms of money. You must be able to see dollars and signs attached to whatever it is, okay? Like, okay, guys, my internet just dropped there. So we are continuing with money measurement concept. All right, and I indicated there to you that anything that does not have a monetary value ought not to be recorded in the books of accounts. All right, so things like, as I gave you the examples there, efficiency of management and stuff like that, doesn't have a monetary value, do not record it in the books of accounts. However, if you have other, all right, guys, my internet just kept dropping on the other laptop. So I've had to switch to another laptop. All right, so the other concept is the going concern concept. Let's see what it says. This concept implies that the business will continue to operate in the foreseeable future. The following are some of the indications of a business that are considered a going concern. All right, I know when you hear going concern, it sounds like, oh, what is Miss talking about? All right, so let's see what it means in relation to accounting, going concern. All right, so if it is a business is set up, basically they are saying to you that if a business is a going concern, it's not going to close. It is not going to close as a business operation. It's going to continue to operate for the years to come. So it is going to be a business that is going to be in operation for years to come. Nobody wants to go into a business for 1 or 2 months, and then after, of course, the couple months, it closes down. That is not good business, and it's not good for investors. So let's see some of the things that will indicate to you that a business is a going concern. The first one is high sales that match or outperform those of the previous year. If it is a business has good sales, they are selling goods regularly and they are making money, that's a clear indication that the business is operating, it's doing well, so it's a going concern. If the current assets that match or exceed current liabilities, and I know some of you may not know about current assets and current liabilities. We are going to learn about it before, of course, the 4th lesson come around. But it basically means the current assets are things like, I'll just give you an example of a current asset, cash, okay? An example of a current liability, a loan, okay, a short-term loan. So if it is your current assets, if you do not have enough money, your current assets doesn't match your current or it exceeds your current liabilities, That's a clear indication that you have enough money, you have enough cash to cover your liabilities. For instance, if it is a short-term loan, it tells you that your assets, which is cash, your current asset, is more than your current liability, which is a loan. Okay, and that's a clear indication that you have enough cash to pay your expenses. So that is another indication that a business is of going concern. The other one is approval for credit by a supplier. Obviously, if it is you want to purchase goods from a supplier is someone who provides goods to you to run your business. If it is, let's just say that supplier is willing to give you goods, then obviously that supplier must know that you have money in the future to pay for those goods. Okay, so that is another indication of a going concern. But let's just see what happens if a business is not a going concern. So the following are some of the indications of a business that is not considered a going concern. For instance, if a company is denied by a supplier, let's just say you want to get goods from a supplier and he or she refuses to sell you the goods. Obviously, it's because they are seeing that your business is not doing very well or it's not in operation. That's one. Two, a company that includes its long-term assets on its quarterly financial statements. Again, a company that includes its long-term assets on its quarterly financial statements. I know that is a bit Greek, but I will just explain it quickly. Your long-term assets are basically like mortgages. All right, if you have a mortgage, anything that is over 5 years, all right, that is a liability. If you put that on a quarterly financial statement, which is a quarterly financial statement is 3 years, that is an indication. That is what it tells you that, listen, why is this business putting their long-term assets into a period that is short-term? Is it because they are thinking about getting out of business? That is one of the questions you're going to ask if you are not a going concern. Okay, that's one of the questions a stakeholder, would ask about a business that is not a going concern. The other one is a company's quarterly reports displays low sales scores in comparison to the previous year. So if it is your sales are looking really very low and you're not doing very well, the business is doing poorly, then that's an indication that you are not doing very good business and there's a possibility that you may go out of business. That's another indication that you are not a going concern. Okay, so I'm going to move on, but all of these information, you can get it on YouTube after. Okay, moving on. The Prudence Concept. Are you all hearing me? Just give me a thumbs up if you're hearing me. Nice, beautiful. Because I told you all that I switched the laptop. All right, let's look at prudence. Prudence is defined as the exercise of caution when making judgments under conditions of uncertainty. It provides for all possible losses, but does not anticipate profits. Very contradicting. So what is being said about this principle is that you ought to be very cautious. You will not put your profits higher than it should be, and you will record all of your losses. If you put your profits higher than it should be, then the stakeholders are going to ask the question, why aren't they getting much more profits? Because they're seeing that the business is making profit and it's high profits. Obviously, they will want to get more interest on their investment. So one of the prudence concept there is that you ought not to record your profits higher, or you ought not to overstate your profits. So you're exercising caution there, as well as you ought not to leave out or not more or less record your expenses. You ought not to think of your expenses as, okay, this small, I will not record it. You need to record your expenses. If you do not record your expenses, again, your profits is going to be higher than usual. So you have to exercise caution when you are thinking about this prudence concept, okay? It gives more or less the stakeholders some more facts, proper facts about a business, about how your business is doing. For instance, debtors, I gave you a definition there of debtors, okay? Reflect the amount an organization will realize in a year, meaning what the business will receive in a year. Since the possibility exists that some debtors may go bankrupt or broke during the year, the prudence concept should be applied before by making provisions for bad and doubtful debts in the books. So according to the saying, you got to take in front before in front takes you. If it is you don't record this provision or this bad debt, then what happens is you are putting the cart before the horse. If it is you sell goods to customers, there is no guarantee that you are going to get all the monies from your debtors or your customers. So you got to make provisions for those who cannot pay. All right. All that is a type of prudence. It's a prudence principle that has to be applied in accounting. All right. Moving on to the other one. Return your sticky. We are going to look at the other one, which is the consistency concept. Let's go through the definition. Consistency in accounting methods prevent misleading profit arising from different methods applied. When the consistency method is observed, users of accounts can make meaningful comparison of financial performance from year to year. Okay, so you have to be consistent, just as how I will say to each student, if you want to do accounts, you have to be consistent. You have to be constantly going into your notes, practicing questions. It's called consistency, okay? So it's the same thing with this consistency principle. If it is, there's a particular method that is used for evaluating goods, and I would, of course, read the example there. If you have a particular method that you are using, you have to stick with that method throughout the life of that business, okay? Unless you see a need to change it, it isn't as easy as changing a method. It's a lot of procedures that would be involved in order for you to change a method, and it confuses as well the stakeholders, because the stakeholders are using the consistency concept for comparison of different year-to-year statements. So if it is one particular year, they have noticed that, oh, I realized that they did not apply, let's just say, the valuation method for stock. They did not apply it in the same way, then it confuses them. So consistency is important in accounting, okay? And let me just go through the example here quickly. If a business is a retailer dealing in shoes and it uses the first in, first out method of inventory valuation, that is the method that is used for valuing the shoes, it must continue to use that method in the following periods. If the business wishes to change its method, it must be disclosed in the financial statements so that the users of accounting information would take note of this change. So before they compare their financial statements, you need to disclose this information, and usually it's at the bottom of the financial statement. You need to disclose that so when they see it, they are not going to be surprised by that change that they have come across. Okay? Good. We are going now to the time period concept. We just have two more and we are going to finish with that. The time period concept. This period concept implies that a business can divide its economic activities into artificial time periods. Okay? This time period vary, but the most common are monthly, quarterly, and yearly. So once a business is in operation, they can decide to do their accounting statements on a monthly basis. They could also do it on a quarterly basis, which is every 3 months, or they could do it on a yearly basis, every 12 months. But for some businesses, if it is they do it, let's just say on a quarterly business, it gives the accountant the idea as to how well the business is doing. All right. You would not want to wait, although some businesses do it, but you will not want to wait until the end of the year to know whether or not your business is doing well. So you just want to get a little preview on a quarterly basis as to how well the business is doing so that you can make changes accordingly. All right. So more or less it enables stakeholders to stay informed. All right. And let me just have some water. Okay. So we have dealt with the time period concept. And the last one is the dual aspect concept. This concept states that every business transaction should be recorded in debit and credit accounts. When we get to our accounting cycle, we would be able to understand what this means. So basically, it tells you that for each transaction, it has to be recorded twice. Okay, that's all it is saying. One transaction debited, one transaction credited. Okay, if you record a debit in a transaction and you do not record a credit to it, you will not be able to balance your books. And we will see that when we get to the accounting cycle. All right. So as well as it also helps accountants in detecting errors. As I said, you wouldn't be able to balance. So in doing this, in applying this concept, you are able to detect errors. Okay. So let's say, I'm just looking at the questions. Okay, Angelina, I'll answer. No, not Adrian. I'll take your question, just on. I'll answer you, Adrian. Okay. So, all right. So, guys, Adrian, be more specific with your question. I don't know what change you're talking about, but I will address it right after, okay? Let's try this. Let's see how well you have understood the accounting concepts. And after that, we're going to just take about 10 minutes to do this. And I'm going to give you the responses after. Okay? Okay, guys. So I'm back. All right. I guess 10 minutes would have been plenty, but I have given you all that 10 minutes so that you can think and read the definitions that are given. All right. You would have noticed that my definitions given are different to what I've given here in this exercise. All right. So it's important for you to understand concept. All right. Once you understand something, it doesn't matter how many ways in which someone would have mentioned it to you, you would be able to put together your thoughts and come up with an answer. All right. So the first one is the prudence concept. When you think about being cautious about your profits, your profits that are overstated and your expenses that are not stated, you need to be very cautious about transactions like that. So the first one is the prudence concept. The second one, the business entity concept, increases the owner's accountability whenever the business capital is utilized for personal use. We know that is a no-no. The business is separate from the owner. The owner should not be incorporating his personal expenses into that, into the business. All right. So the second one is the business entity concept. All right. The third one is the historical cost concept. All right. Where items ought to be recorded at its original cost. And we said that is because if you have to dispose of that item, you would be able to know whether you made a gain or a loss. So the third answer is historical cost. The fourth answer is going concern. The going concern concept of accounting implies that the business entity will continue its operation in the future and will not liquidate or be forced to discontinue operations due to any reasons. Okay, so that is the fourth answer, going concern. The fifth answer is money measurement. Of course, I feel I should have numbered these because I didn't number it, sorry. The fifth answer is money measurement. So what I'll do, I'll read it so you will know it's the fifth one I'm talking about. All right, the money measurement concept is based on the theory that a company should be recording only those transactions that can be measured in monetary terms on the financial statement. If it does not have a monetary value, you should not record it in the financial statements. So your fifth answer is money management. The sixth answer is consistency. The consistency concept states that all accounting treatments should always be followed throughout the current and future period unless required by law to change, or the change gives a better presentation in accounts. So, Adrian, I know you asked that question. So basically, Adrian Miller, if it is, yes, if you have to make the change, you can as a business. But as I said, it's going to be costly because you will now have to get your staff to reverse the method that you were working with before. So to reverse that, it is really going to be a bit difficult, and it kind of like confuses the whole accounting. Not that it couldn't be done, it can be done, but it's only if you are instructed by law to change it, or if it is, you can give a good reason as to why you want to change it. For instance, the presentation of accounts would be better if you can state that, and the stakeholders could understand why, and they can see with what you're saying. Yes, you can change it. Okay, but it's hardly likely and it's hardly recommended. Okay. Excuse. The seventh answer is time period. The time period concept enables financial statements to be prepared at the time for which reporting is done. So if you choose to do your financial statements once a month, quarterly, which is every 3 months, half yearly every 6 months, or every 12 months, yearly, that's up to the accountant. If she wants to follow how well the business is performing, or if the investors or the stakeholders on the whole are pleased with what they are seeing and they need to get regular updates, yes, you can do it during those time periods. And the last answer, of course, would be dual aspect. And as I said, just hold 1 second. I don't want to be coughing here constantly. The last one is the dual aspect, where every transaction that you have to record in your accounts must have a debit entry and, of course, a corresponding credit entry. And when we go to double entry, we would learn that part of it. So those are the principles that, and concepts that are important for recording information in your accounts. All right. And now we can move on. I hope you all found it easy and you would have gotten most of them correct. Okay. So now we are moving on. Just a minute. No, Laura, quarterly is every 3 months. Quarterly is every 3 months. Okay, so sure, Luke, I'll give you the answers again. So your first answer is Prudence. The second answer is business entity. The third answer is historical cost. The fourth answer is going concern. The fifth answer is money measurement. The sixth answer is consistency. The seventh answer is time period. And the eighth answer is dual aspect. All right. I hope that answers your question, Luke. Okay, great, I'm glad. Good. Okay. Guys, you can go on YouTube. All right, and of course, once you listen, you'll get your answers. That's correct. Jamel, that's correct. All right, quarterly is every 3 months. Okay, so we're moving on because I'm seeing time is against us. We are pressed for time here. So we're going to move on, guys. So we're going to look at types of business organization. Okay. It's important for you to know this. And of course, if you are principles of business student, this topic will help you. All right. But we do this topic in accounts because when you are preparing your financial statements for stakeholders, whether you are a sole trader, partner, a corporation, cooperative, non-organization, non-profit organization, your financial statements are going to be prepared differently. And you will see that as you go along. There's no need for you to know that now, but that is the reason for us touching on types of businesses. So let's see what is a business. A business can be described as any activity engaged in by one or more persons where goods and services are provided with the specific intention of making a profit. Now, nobody wants to get into a business to make a loss. So the aim or the objective of all businesses is to make a profit. So you can just look at that definition and we are moving on. Let's look at some of the key features of a business organization. We're going to first look at the sole trader. A sole trader business is where one individual, okay, one person, or a group, it could be a group of people that exist. So let's just say there are 3 or 4 people in that group, they're acting as one. So you will still see it as a unit. So it is where one individual or a group acting as an individual owns and controls the business. So examples of sole traders are plumbers, electricians, hairdressers. I have given you some examples of sole traders there. They run the business on their own, all right? They do not have to register their business. So if it is, you decide, and of course, as a student, if you want to purchase, let's just say cellular phone covers or whatever it is, or let's just say the headsets, cellular phone headsets, you want to do that as a business, you don't have to register your business. You can purchase it, and of course, you can now sell it at a markup, of course, to make a profit because you are running a business. So you put a markup, you make a profit, you are a sole trader, you are doing it alone. Okay, or you and your friends can come together. You all can put money to purchase these Bluetooth headsets. You all can come together as one group and sell some of these headsets at a profit. You are still operating there as a sole trader, although there are many of you all in that one group. Okay, so let's see about the source of financing. Your source of financing could be your personal asset and savings. So when I say personal asset, if it is you more or less have machinery, let's just say machinery for let me see, making, well, you are a seamstress, okay, and you make clothes or for women. All right, you have your own personal asset. The asset there is your machinery. Okay, your sewing machine is your asset. Okay, so that could be a form of financing for you. You're using your machinery, all right, in your sole trading business. Or it could be that you have some money. You know, you may have gotten a lump sum of money from a family member and you want to do some type of business. Think about the type of business you want to do. You don't have to register it and you can get started in your business. Okay. The legal responsibility. The owner is personally responsible for the business debts. So if it is you're a sole trader and you get into an investment and for whatever reason the business did not make money, you are responsible for that debt. You cannot call your customers that you have sold items to and tell them, here's what, I need to make or get some money from you to pay for my business debts. No, it's your debt. You're a sole trader. You handle your own debt. All right. In terms of management, again, usually the owner takes an active management role, especially if it's in a small firm, like for instance, a local, well, corner shop or so. If it is you have like a grocery, all right, and you are a sole trader, you are the one who you manage that business. It's your business. So you will handle that. You may not want to hire someone to manage the business for you. Although people do that, they get into a business and they put Harry, Paul, or Gina, or whoever to run the business for them, another person who can manage the business for them. Nothing is wrong with that. But of course, you would be responsible if you have opened a sole trader type of business, you are responsible for managing the business. All right, in terms of profit or loss, of course, since you are the one that is handling every aspect of the business, all the profit would be yours. If you make a profit, if you make a loss, unfortunately, you will bear all of your losses. Okay, so that is in terms of sole trader. We're going to look at partnership. Okay, partnership. A partnership is a form of business where two or more people, but not more than 20, voluntarily join in a business venture to earn profit. Again, this is another type of business, and their aim is to earn profit. So some very common types of partnerships are law firms, physician groups, real estate. All right, this is where 2 or more people. It could be 2, 3, 5, 7, 9, 10, but not more than 20, all right, will form that partnership. Okay? That is in relation to the description there. In terms of financing, each partner contributes an agreed amount. So if you form a partnership, let's just say 5 people form a partnership, not all of them have to put the same amount of finances or the same amount of money into that partnership. There can be an agreement where each person of the 5 want, let's just say you want to raise $10,000 for the partnership. One could put a 2,000, the other one put a 2,000, the other one put a 3, the other one put 1,000, and the other 2, 1,000. Okay, so it doesn't have to be all the partners will come up with the same amount of money. So the source of financing is where each partner will come up with an agreed amount. In terms of legal responsibility, unless otherwise stated, each partner is responsible for a share of the business debts. Now, there are some partnerships where the partner, like for instance, there are different types of partners in a partnership. You have like the silent partner, the active partner, who is more or less the general partner. These partners all help out in the business. But of course, the silent partner is one who doesn't really have much input in the business. He just puts the money into the business and he doesn't really pay much attention to the operation of the business. All right. So it doesn't always mean that each partner is responsible for the debt of the business. It could be agreed that if a partner puts money into the business, he can say, look, listen, the debts of the business should be more or less for the general partner. Okay, or so. All right, it doesn't have to be that way. It doesn't have to be that everybody must pay the debts of the business. There can be an agreement that can state otherwise. In terms of management, partners may or may not help to manage a business. All right, as I told you, the silent partner there doesn't have to take part in the operation of the business. He just invests his money. He doesn't have to be a part of the business in terms of the operation. Large businesses may employ professional managers. Again, if the partners feel that there isn't anyone to handle the daily running of a partnership, they may hire professional managers. They are not partners in the business. The partners in the business will hire someone like a manager outside of the partnership to run the partnership. Okay? And in terms of profit or loss, again, an agreement has to be made up by law. In that agreement, all of how the profits are going to be shared, who brings in how much capital, who will get a salary, who would be paid interest, all of these information would be more or less written in an agreement. So the agreement will state if it is like 2 out of 3 people are taking an active part in the partnership. You can say that the third person, one person might get 1/3, well, 3 people, sorry, each will get more or less 1/3 each. But if it's 2 people and the one who is doing more work in the business, that person who is doing more work in the business will get 2/3, while the other one will get 1/3. Okay, remember the partnership consists of between 2 to 20, all right, persons. All right, I hope that is clear. All right, moving on. Limited liability companies. Limited liability companies are companies owned by shareholders who each contribute to the funds needed to establish and run the company. So a limited liability company is more or less a company that is formed by the owners. Owners are the people who are considered shareholders of the company. Each of them will put a portion of their finances, or each of them will invest in the company. All right, they are referred to as shareholders. So once a limited liability company is formed, they will have shareholders who will put whatever they can afford to invest in that company. So the source of financing, it is contributed by owners purchasing shares at variable offer prices. The word variable means that it doesn't have to be fixed. When I say fixed, it doesn't mean that if 100 people form a company and they are all shareholders, not each of them will have to put 100. Some could put $10, some could put $20, some could put the whole $100, okay? So variable means that the amount that each person puts into the partnership doesn't have to be a specific amount. It can vary, okay? The legal responsibility. The company is responsible for the business debts, not the shareholders. So when this company is formed, the shareholders, although they are owners, limited liability means that you are liable for only the amount of your investment. So you would lose only what you have invested and no more. So you will not lose your house, your car, whatever asset you have. You will not lose that if you are in a limited liability company. You are liable to lose just what you have invested and no more. So the shareholders, they are not responsible for the debts of the company. So let's just say the company goes into some real financial problems. The shareholders will not be responsible for paying that debt. I hope that is clear. In terms of management, usually there is separation of management and ownership. That's basically tying into the one that we had spoken to there. Okay, just a minute. Risha, I will get to you, honey. I'll get to you just now, love. Okay, so in terms of management, it ties into the legal responsibility there. Management usually is separate. Usually there is separation of management and ownership. So really and truly, you do not have to have shareholders running a company. You can get people outside of the company to run the company. So what will happen is the shareholders, they are going to elect a board of directors to run the company. Okay? So it doesn't have to be the shareholders who is running the company. The shareholders can elect a board of directors. These are people who would look after the proper running of the company. And in terms of profit, loss, shareholders share in profits via dividends. Dividends is like interest. When you get interest on money that you have invested, Instead of saying interest, you have made interest on your investment, you call that interest dividends. Okay? Of course, the other part says dividends. Let me just read that again. Shareholders share in profits via dividends. That is, if the company makes a profit, then of course they are going to give dividends to their shareholders who would have invested in the business. But if the company did not make a profit, nobody gets dividends. Okay? Again, if it is the company does not make a profit, nobody gets dividends. None of the shareholders get dividends. Okay. Sure, I will. Let's move on. Cooperatives. Looking at, we are pressed for time. Cooperatives are organizations that are formed and controlled by members. They are run to provide their members with goods and services rather than to make a profit. We have, well, at least two cooperatives that I'm familiar with is the El Dorado Cooperative Society, which is in Tunapuna, and they have the Diego Martin Cooperative, which is in Diego Martin. Now, these cooperatives are more or less run so that they can provide for their members. So their members are going to get like cheaper goods. Some of these cooperatives provide agricultural goods. Okay, agriculture, sorry. And what happens is that these goods are going to be sold at a cheaper price. It doesn't always have to be agricultural goods. It could be food stuff, any other type of food stuff. Their aim is to be able to buy it on a wholesale basis so that they can sell at a cheaper price to their members. And that is the purpose of cooperatives, so that they can buy goods wholesale and sell to their members at a cheaper price. Okay. Of course, the source of financing, it's like something like Price Mart. You pay a fixed amount of money for membership. So like Price Mart, I believe is what? I think it's about $200 now to get a membership card. Well, the fact is, I don't remember how much a cooperative will charge to get membership, but to get a membership, you must be able to pay a fixed amount, meaning that if one member is charged $100 for membership, all the other members who are part of that cooperative who are members, they will pay $100 each. It means that that amount is fixed. Remember, if it varies, then the amount would be different, but this is fixed. So the amount there would be the same for all members to pay. In terms of responsibility, the cooperative, okay, I'm seeing a question here, Akila. Chaguanas Borough Corporation is not a cooperative, okay? And I'll tell you why after class. Legal responsibility. The cooperative is responsible for the business debts, not the members. So let's just say the cooperative, El Dorado Cooperative, fall into some financial difficulties. The members are not liable to pay the debts of that cooperative society. In terms of management, the members volunteer to run management committees. Okay, so they're going to have a committee where they're going to elect members. These members can consist of principals, teachers, supervisors, people who would be familiar with business. Some of them will volunteer to work in the cooperative so that the cooperative is up and running smoothly. Of course, if there are any profits, then of course they will probably benefit from the profit. But of course, they can also, if it is they do not have members to run the cooperative, they can hire someone outside who is not a member to come in to manage the cooperative. All right. And in terms of profit, loss, the members, well, of course, if it is the cooperative if the cooperative make a profit, then the members will benefit. And of course, they would be paid a dividend, something similar to the shareholders. They are paid a dividend, all right, if it is the cooperative makes a profit. And I believe this is the last one we're going to look at here quickly. Nonprofit organizations, these are organizations that are run for the benefit of their members to engage in social and sporting activities and not to make a profit. So we're going to use an example of the churches. Some of the churches, they will get assistance, from the government, or let's just say some of the Catholic churches, what they do is they pick up money for, of course, their contributions for the priest. But apart from that, that is not a non-profit organization there. The priest has to be paid. But what will happen is there could be a second collection for people, like for the poor house or St. Paul. I think that is one of the areas that charity is given to for people who are less fortunate. So the aim of this type of organization is not to make money. The aim is to be able to provide for the less fortunate, the ones who are unable of helping themselves financially. So they get assistance from the church, they get assistance from other charitable organizations, etc. Let's look at the source of financing. Of course, I said that they generally receive money through donations and grants from government. Okay, when I put the word there, state, I'm talking about the government. So the government is going to assist in these charitable organizations to assist people who are less fortunate. In terms of responsibility, the government is responsible for creating laws to protect whoever that gives donations and to prevent nonprofit organizations from using donations for any other purpose. When you are given money as a charitable organization that is assisting people, please, you ought not to be taking that money for your personal use. The money is to help those who are not in a very good position financially. This type of organization is managed by trustees, people who are reliable and trustworthy. Okay, you do not want to hire anybody dishonest to run a charitable organization. And in terms of profit and loss, because this type of organization is a non-profit making organization, there is no profit to be distributed to anybody. What they do is once they have run, let's just say they have any kind of event and they made money, the money goes back into whether it is a hockey club. A hockey club runs a charity. Let's just say the hockey club has a raffle and they've made money from the raffle. Whatever money that is made, it goes back into the hockey club to purchase new equipment or whatever that is needed. Okay, so that's just about it. I hope that was clear enough for you. I have just about 5 an exercise here where you are to fit in these types of business organization into the spaces provided. Okay, so we can do that, although I'm looking at, we just have about 2 minutes for okay, guys, so you all are going to fill these blank spaces with the respective type of business for me. We are going to correct it. And any question, you can just direct them to me. All right. So that's just about it. Go ahead. You have just about 5 minutes to answer, to do this exercise for me. Okay. Okay, guys. So I'll just give you the answers to this exercise. Are you all hearing me? Thumbs up. Nice. Okay. Good. So number 1, your answer is cooperative. Okay. Number 1, cooperative, a business organization that is owned and operated by its members. Cooperative. Number 2, a legal agreement between 2 to 20 individuals who undertake the forming of a business unit with a common view of making a profit. We'll be talking about a partnership there. The second answer is a partnership. Number 3, a legal entity organized and operated for a collective, public, or social benefit would be a non-profit organization. Number 3, non-profit organization. Number 4, a business which is a type of legal entity that can be used when forming a business that offers protection to an owner or owners from personal liability for debts and other obligations that a business might incur. Your answer there is limited liability company. I know it's a bit lengthy there, but read it, break it down. We are talking about a legal limited liability company. All right, and number 5, your answer, of course, is a sole trader. All right. I hope you would have been able to come up with those answers. And any questions, feel free to ask. All right. Okay, so okay, guys, so until next week, please God. All right. Have a wonderful week ahead, and until next week, Monday. Bye.